All right, so you know how sometimes you glance at your investment portfolio and it's like, whoa, did someone sneak in a roller coaster ride in there? Sure. Yeah, we feel you. This market's been a bit of a bucking bronco lately. But hey, that's why we do these deep dives, right? To arm ourselves with knowledge. Because like they say, knowledge is power, especially when the market feels like a wild rodeo. Today, we're tackling two analyses, one big picture economic thing and one market-focused podcast episode. The goal, to give you the insights you need to navigate this interesting market climate. Our first source, they're calling this a perfect storm hitting the markets. And you know what they lead with? Geopolitical tensions. Not exactly the cheeriest way to kick things off, is it?
Yeah, geopolitical tensions doesn't exactly make you want to jump for joy, does it? But hey, that's the reality we're dealing with. And understanding these events, these global tremors and how they ripple through the markets, that's key.
Yeah, like that whole Iran-Israel situation, talk about a powder keg. Feels like every time you turn on the news, it's like another layer of tension.
Mm-hmm.
How's that impacting things from an investor standpoint?
Well, we're seeing a classic flight to safety. Investors get nervous. They start looking for a safe place to park their money. Like imagine a storm's brewing. Everyone's rushing for shelter. In the financial world, those shelters, that's your U.S. treasuries, your gold assets that tend to hold their value or even go up when things get dicey.
They're like that reliable friend you call when you need a shoulder to cry on.
Yeah.
Always there, always steady.
Exactly. But it's not just the geopolitical stuff that's got investors feeling a bit on edge, right?
We've got to talk economics. Our analysis points to a few, let's say, less than ideal economic indicators, specifically U.S. GDP growth, kind of like that runner who started strong but is now, maybe hitting a wall. And then there's unemployment ticking up a bit.
Yep.
What's a takeaway for investors? Should we be hitting the panic button?
Okay, so those indicators, they do suggest the economy might be slowing down a tad. And yeah, that can make investors nervous. Slower economy, companies might see their profits shrink, and that can lead to lower stock prices. It's all connected.
So not a 5-alarm fire, but definitely maybe a reason to check the batteries in your smoke detector, just in case.
Exactly. Be prepared. And then, of course, there's the whole inflation interest rate puzzle. Our source, they described it as the Federal Reserve trying to walk two dogs pulling on leashes in opposite directions. Talk about a balancing act.
Oof. Yeah, that image is stressful for the Fed and for investors, I imagine.
Absolutely. They're trying to control inflation, right? Like trying to get one of those dogs to chill out. But they also don't want to slam the brakes on the economy because that's the other dog, face planting. They're aiming for this delicate balance, and investors, they're watching every move, every twitch of the leash.
So we've got global unrest, economic question marks, and the Fed walking a tightrope. No wonder investors are feeling a bit jittery. But is this perfect storm really all that unusual? Have we seen this movie before?
Well, here's the thing. While the specific events, they're always unique, these patterns, these market reactions to uncertainty, we've seen those play out time and time again throughout history.
So we're not sailing completely uncharted waters here. That's got to be somewhat reassuring, right?
Exactly. Take that flight to safety we talked about, with investors shifting towards those safe haven assets. That's a classic market move when uncertainty kicks in. Recognizing those historical echoes, it can be super helpful. It helps us stay grounded, make more rational decisions.
Makes total sense. Our analysis also highlighted how big institutional investors, like those massive pension funds, they're reacting differently to this whole situation than us regular, everyday investors. Why is that distinction important?
Time horizons. It all boils down to time horizons. Those big institutions, they're playing the long game. They're managing money that might not be needed for decades, so they can ride out these market swings a lot easier. But individual investors, we might have more immediate financial goals on our minds.
Yeah, like retirement's calling, or maybe that down payment on a house, or even just like finally taking that dream vacation you've been putting off.
Exactly. So our decisions, they're often driven by those shorter-term needs and worries, and that can lead to different reactions to whatever the market's throwing at us.
It's like we're looking at the same market, but through completely different lenses, The big institutions with their telescopes focused way out there on the horizon, and then us, with our magnifying glasses, trying to make sense of the here and now.
And both perspectives are important, right? You need that big picture, but you also got to know what's happening right in front of you.
Absolutely. Speaking of different perspectives, let's switch gears to that Economy and Market Today podcast we flagged.
Yeah.
What were some of the things that really jumped out at you from their conversation?
Well, they spent a good chunk of time on that whole U.S. government almost shutdown situation.
Oh, yeah, that was a nail-biter for sure.
Yeah.
Okay, but real talk for a sec. what does that kind of political drama actually mean for our portfolios? Like, besides just adding to the general sense of, whoa, everything's a bit chaotic right now.
Right. It's about more than just the headlines. See, that close call, and it was close, it injects this layer of uncertainty into how the government's going to approach things like spending, economic policy. And that uncertainty, investors don't love it.
Makes sense, like trying to plan a cross-country road trip when you're not even sure you have enough gas money to get out of your driveway.
Exactly. And speaking of things that might give investors pause, those podcast hosts, they were really digging into those soaring bond yields we touched on earlier.
Oh yeah, they called it a canary in the coal mine situation. Right. That image definitely stuck with me.
Right.
But I gotta admit, I'm still not quite connecting all the dots on that one. Help me out here. What's the deal with bond yields and why should we care?
Okay, so bond yields. Picture this. You buy a bond, right? You're essentially lending money, could be to the government, could be to a company. The yield, that's the interest you're getting on that loan.
Okay, so higher yield, more money in my pocket, sounds like a win. What am I missing?
Here's the thing. Bond yields and bond prices, they move in opposite directions. It's a seesaw. When yields go up, prices go down, and vice versa.
So it's like if you try and decide between two equally tempting desserts, and suddenly one of them is half price, you might be more likely to grab that one, even if you originally had your eye on the other.
Exactly. Investors, they're always on the lookout for the best return on their investment. So when bond yields go up, those older bonds with the lower yields, they become less appealing, even if their price drops. It's all about supply and demand.
So what are these rising bond yields telling us about the market right now?
They're sending a signal, and it's not necessarily a happy one. This rapid rise in yields. It suggests investors are bracing for a potential economic slowdown, maybe even higher inflation down the road. They want those higher yields, even if it means accepting lower prices for existing bonds in the short term.
So back to that canary in the coal mine analogy. Are investors reacting like there's a whiff of danger in the air?
Exactly. They're seeing those yields climb and thinking, maybe it's time to batten down the hatches.
Bond yields.
Yeah.
The canary, the signal flare, the friend who gives you that subtle look across the party when it's time to head home.
Love it. And speaking of things that make you go, interesting, the podcast also got into the whole oil situation. Prices soaring past $100 a barrel.
Yeah, not exactly music to our ears at the gas pump, is it?
Nope. And they pointed to OPEC production cuts, basically limiting supply, and then you've got increased demand from emerging markets, and that's a recipe for higher prices.
And this is good news for energy stocks, right?
Bingo! It's classic sector rotation, another term those podcasters used. When uncertainty kicks in and the overall market feels shaky, investors start shuffling their money around.
Moving it out of the sectors that feel kind of, risky at the moment. Tech stocks come to mind, maybe some retail, and into sectors that feel a bit more, I don't know, maybe stable is the word, or even poised to benefit from all this, like energy.
Right, like rearranging the furniture in your living room, you're not getting rid of anything, just shifting it around to create a cozier vibe for this whole economic weather system we're in.
I like that. And that brings us back to that idea of safe haven demand, right?
Right. Exactly. When things get rocky, investors, they crave stability.
They want that financial equivalent of a warm blanket and a cup of cocoa.
Exactly.
Our sources mention gold, but also a strengthening U.S. dollar.
Right. When uncertainty strikes, the U.S. dollar tends to attract investors. It's seen as like this reliable, steady currency.
The strong, silent type of the currency world.
Yeah, something like that. And that can be a good thing domestically, helps keep inflation in check. But
there's always a but, isn't there?
More like a however in this case. A strong dollar can actually make things tougher for emerging markets, for economies that have a lot of dollar-denominated debt. It's this, global dance, Each step impacts all the other dancers.
Okay, so big picture. We've covered a lot of ground here. Geopolitical tensions, the economy sending us mixed signals, those bond yields whispering cautionary tales, the whole oil situation. Let's shift gears for a second, from analysis to action. If we as investors want to make smart, informed moves amidst all this chaos, what are the key takeaways we should be jotting down?
The first one, and we've touched on this a few times, is diversification. That old saying, don't put all your eggs in one basket, never been more true than when the market feels like a roulette wheel.
So spread those investments around. But we're not just talking about stocks versus bonds, right?
Yeah.
It's about getting more granular, looking at the actual companies we're invested in.
Exactly. Remember all that talk about quality stocks and strong foundations? Think of it like this. You're building a house. You wouldn't build that house on sand, right? You want solid ground, sturdy materials, a structure that's built to last.
And in the corporate world, that translates to
Companies with a solid track record, consistent earnings growth, manageable debt levels, those are all good signs. You want companies that can weather the storms, economic ups and downs, all that.
companies that can handle a little rain, maybe even a full-blown hurricane, and still stand strong.
Exactly. Now remember, no one has a crystal ball. There are no guarantees in investing. But by focusing on quality and diversification, you're essentially building a more resilient portfolio, one that can roll with the punches, whatever the market throws its way.
Okay, so diversify wisely, focus on quality. Got it. It's like packing this awesome all-weather travel kit for our portfolios, right?
I like that.
Got your raincoat for those market showers, a sturdy umbrella for the downpours.
And maybe even a compass for those times when the path forward isn't so clear.
Love it. Because even with the best forecasts, the best laid plans, the market has a way of throwing a curveball every now and then. Which brings me to my final thought for you today. We've heard from some really smart people, considered different angles, different perspectives, and it's clear there's no one-size-fits-all answer on how to handle this market roller coaster we're on. But that's okay. It's your portfolio, your money, your financial journey. And the most important thing is to keep learning, keep asking questions, and ultimately make decisions that feel right for you. Thanks for joining us for another deep dive. Until next time, happy investing.